SoFi stock indeed did not hit a new all-time low today. SoFi stock actually did head upwards about 1.11%. Now, we have our main catalyst, which is the Federal Reserve interest rate decision that comes out at 2 p.m. and then the Fed press conference that comes out at 2:30 p.m. Now, for those of you guys that have puts, or if you have calls, you want to watch this video, or if you're just invested in the stock market in general, and I'm assuming that if you're watching this video, you probably are. You want to watch this video because I don't really think there's going to be a negative reaction to the Fed, and I have some data and some points that I want to make with you guys to help put this move into context. We have seen a very, very turbulent, violent move over the past 2 days. We hit a low of 405. Now we're back to 416, 417 on the spot. There's a lot we need to cover, and I hope this video finds you guys right, and I hope it helps you make some money, or at least, at the very least, put this into some kind of perspective. So hit the like button, subscribe to the channel if you guys have not already. I do greatly appreciate those of you guys that went ahead and did that. Those of you guys that have already subscribed to the channel, thank you guys for everything. So first things first, we'll talk about SoFi. We'll talk about the data you guys need to know, all of that, what hedge funds are doing with SoFi. We'll get into that. I do want to focus on the Fed first things first, because what happens tomorrow will affect SoFi stock more than anything else. Forget directors leaving. Forget, insiders buying the stock. Forget any good or bad things you think about SoFi right now. It doesn't even matter when it comes down to the Fed. The Fed is a multitude larger of a catalyst by like 50 times large. It doesn't even matter what SoFi does specifically. Now, why do I think the Fed will actually be a bullish catalyst for the markets? Well, if you look at a 15-minute candlestick chart of the S&P 500, just back here, April 21st, we were at 450 on the SPY. We went all the way down to 405 on the SPY. That was yesterday. And then what happened? You've seen a massive reversal. As soon as we hit literally 405 and 2 cents, we shot straight up from there, literally coming back to the previous highs of that trading day yesterday. This was an $11 reversal in the last hour and a half of trading or so. So this was massive. And what you can see since then, you've kind of seen a bullish trajectory starting to form. Now, that's not even close to why I think the markets are likely to rally after the Fed. But I want to put this charting into context for you guys, as well as what happened last Fed meeting. Last Fed meeting, it looks a lot like where we are currently at right now. We had came down. The high for the year on the stock market was January 4th, 2022. Ever since then, we went through the floor. The markets were not in a great place, and that was right here during the last Fed meeting. But what happened after the Fed meeting? The markets just took off, and you did get a flush out zone, which we came all the way down to 409.37. We actually hit the low, like I said, 409.37, and we closed the day at 426. That was, again, like a $9, $8 reversal. Actually, that was much more than that. Never mind. That was a huge reversal that day. Like a $13 reversal this day in the S&P. I don't know what I was looking at there. So a massive reversal. Stocks obviously went up, came back down a little bit, touched the lows. Fed meeting came, and you've seen a very, very bullish rally. I don't think we would have seen a bullish rally over here if the markets did not flush out a lot of that negativity this day and see that massive reversal. It kind of changed the tone of the markets. We went down to 409 during that flush out, but we only ever went as low as about 414 on the SPY after that. Now, what are you seeing right now? We went to 405. Now we're hanging out in between, 414, 416. So you've seen that flush out again, and you're sitting at these low levels like we were during the last Fed meeting. But on top of that, the net long exposure from hedge funds right now is at the lowest level since 2008. Now, what exactly does that mean? Well, the net long exposure would be literally as it sounds. The net long exposure. Say a hedge fund has $100 in long positions. call it $100 of SoFi stock, and they've also shorted $50 worth of SoFi stock, while they would have a net long exposure of about 50%. 50% short, 50% long, net exposure to equities on the long side of 50%. All right, so you guys got that. And you see this article that came out March 15th, as soon as the Fed meeting actually came out, the day of the Fed meeting. It says investors dump stocks, flee to cash as growth outlook hits weakest since 2008. And you're seeing that playing out again. Everybody is afraid of the Fed. Everybody is panicking. You can even see this through the put to call ratio. The current put to call ratio on the index put to call ratio is 1.52. The total put to call ratio is 1.22. What's a normal put to call ratio? Or what is a good put to call ratio? It says, so an average put to call ratio of 0.7 for equities is considered a good basis for evaluating sentiment. In general, a rising put call ratio or a ratio greater than 0.7 or exceeding 1 means that equity traders are buying more puts than calls. So essentially where we sit right now on the indexes, you're pretty much getting 2 puts for every 1 call that is placed on the markets. And when you tend to see people this bearish in the short term, you tend to get very, very violent rallies. That's just how it tends to be. Historically, that's what happens, right? If you're bullish heading into a Fed meeting, you're more than likely going to get a downside move because everybody thinks stocks are going to the moon. They're just going to keep going up. And it's a lot easier to drive the markets down. Vice versa. If the markets are in the floor heading into a catalyst, then it's a lot easier to push the markets up. But beyond that, let's look at the bigger picture here. I say this all the time. The only thing the markets hate more than bad news is uncertainty. The Fed meeting is uncertainty. So as long as we get what we expect, a 0.5% rate hike, the Fed starting to reduce, bonds at about $95 billion per month. As long as we get that, not less, not more, the markets will probably react very favorably, because here's another saying that I like to say all the time. The markets trade off of fear and greed. But ultimately, they reverse back to fundamentals. So if the fundamentals are staying, pretty neutral, right? For context here, about 80% of stocks that have reported earnings have beat on their earnings. Some have guided down. I'm not sure the actual statistic for that one, but 80% of stocks have beat earnings estimates. So the fundamental picture here looks decent, right? It's not wonderful. It's not terrible. It's decent. One would even call the earnings a big bullish sign, right? So you have that going on. And then you have a major fear catalyst, which is controlling the markets right now. Fear and greed. Remember that. The fear is controlling the markets. Once that catalyst comes and goes, there's no more real fear. We already know what to expect. The uncertainty is gone. Then we can get back to fundamentals. And I think it's safe to say on a lot of stocks, the fundamentals, should have these prices a lot higher. Point out an obvious one here. Sofi stock. If you're a long-term growth investor, very, very attractive fundamental valuation. All the other fintechs, Square, PayPal, you could even argue that something like Microsoft or Google or Tesla is even undervalued given the rates of growth that they are expected to see. And what they report on earnings is they're beating their estimates. By and large, beating their estimates. Tesla expecting 60% growth year over year. It's hard to say that these stocks are overvalued when they're performing so well. Even today, look at what we are getting out of Airbnb and AMD. Airbnb beats estimates with 70% revenue growth as travel rebounds. AMD, sales jump 71%, shrugging off concerns about PC slowdown. So you're getting a lot of good earnings, really, really great earnings. Honestly, better than what I had expected heading into this earnings season. It's the fear that is ultimately controlling the markets. And when you have this many people bearish on the markets, you don't want to be in that camp. That's kind of a signal to stay back or potentially just buy the dip. Now, I know a lot of people are saying, well, wait, look, we're heading into recession. Yes, I get all of that. This is more of a short-term call, say in the next couple of weeks. In my opinion, after the Fed, next couple of weeks, you could likely rebound in between 430 and 445 on the S&P 500, even as high as 460 if we do make this ping pong like activity back and forth, right? Go back to the high after the last Fed meeting. That would put us at about 461. In this range is kind of what I expect. Now, the markets, in my opinion, will come down. They will in the next, call it 6 to 12 months. The markets will likely be in a worse situation than they are right now. That's what history shows us. Look at 2018, 2019, right? Markets come down, they go up a couple times, and then they come straight back down, and then they hit all-time highs. And then you get the flush out, and then you get the real crash. And I point this out because this is the only other time in history you have seen the Fed reducing their balance sheet in a dramatic way, reducing their balance sheet about $800 billion, give or take. And that's where the markets absolutely lost their cool. And you've seen the stock market crash, but it still took a year from over here. January 2018, stocks had initially fallen, and then you didn't get the actual full-on market bottom until around Christmas time. December 24th, 2018, that's when you actually hit a low. So this was a whole year that the markets did this back and forth. So that's more comparable, I think, to what we are going to see. I will tell you guys, the markets will fall in a substantial way, either when a recession happens or when there is more clarity of a recession is pretty much coming, when the Fed continues to raise interest rates very, very aggressively, which we are in the early cycles. We are not there yet. Let me just tell you guys, we are not there yet. And once earnings actually start to miss in a substantial way, that's where the fundamental valuations, you got to put that into question, right? Say if Tesla says they're growing at 50 to 60% per year, that's all fine. Maybe you could justify its valuation. But now what if Tesla is only growing at 30% per year? Well, you could make the argument that Tesla would be overvalued in that case, right? But they're hitting those estimates. So you have to look at the fundamental picture once big fear catalysts are gone, is what I'm trying to say. And the fundamental picture does not support heading down under 400 on the SPY. Now, if the Fed does throw us a curveball, which the Powell has been known to do that, 2018, 2019 was a bit of a curveball, then 405 would be the level that I would watch after the Fed. I simply don't think we're going back down there, but still, it's a very important level to be watching. $400 on the SPY as well. That's going to be the next level. If we break under 400, then you're really in no man's land. And then it's really hard to say where we could go. We could go as low as 360, or, we could find support at 380, 370, 390. But I simply don't think we are at the breaking point for the markets as of right now. Large tech stock earnings have been too good to really, break down. When, 5 to 10% of the largest stocks, right, or 5 to 10 stocks control 50% of the broad markets, those stocks have to fundamentally come down in value to see the whole markets come down. It doesn't even matter what a PayPal or Square is doing, because they don't control or SoFi for that matter, because they don't control enough of the markets to cause that kind of move. So don't be naive to all of this. I know people are hoping for a bearish reaction. A lot of people are. A lot of people have trades on it. I don't know what'll happen. This is only what the data is telling me. This is my personal belief. I totally could be wrong. So don't base any trades based off of what I say. I'm not a financial advisor. I can't tell the future any more than you can. But this is really what you need to know heading into it. People are extremely bearish. My experience, it's not the time to be bearish when everybody else is, unless you have a systemic problem like the great financial crisis 2008, or you have COVID 2020, like real fundamental situations developing. That's where the situation becomes a little bit more dire, like we could crash next week kind of dire. So hopefully you guys found some value out of that, some good perspective. Now let's talk about SoFi stock. So the market cap is only $5.76 billion as of right now. Still a very good potential buyout. I don't want that to happen, but I do think at these prices, it's very attractive for companies to try to do a hostile takeover of SoFi. Something, a company Essentially, if they could control 51% of the shares, they could try to do that hostile takeover. I don't believe it's actually possible with SoFi, so they would have to put in like a formal, bid for the stock and all of that. But I think at these valuations, it's very, very attractive. Now, yet again, you are seeing a lot of short-term put activity and a lot of longer dated call activity. A lot of that January 2024, 2023 call activity, and then a lot of short-term put activity like April 29th, $7 put right there, and October 21st, $10 put right there. So I think that says a lot right there. A lot of short-term, bearish pressure, and then a lot of long-term bullish optimism. So that's that. As far as the day, 12% positive order value, 5 orders totaling $317.59 thousand. So again, very, very bearish. As far as SoFi short interest of free float, that is 19.63%. Current shares that are sold short, 141.83 million. Cost bar max of 3.94%. Utilization still at 100%, and days cover sitting at 3.86. So all things said and done, when you do see a reversal in the markets, that's a lot of short interest. 141 million shares is nothing to sneeze at, and I think that will help drive SoFi stock up dramatically on, a daily basis once that day finally does come. And if somebody knows these market makers and could let me know when that day would be, that would be highly appreciated. All seriousness though, it is going to happen, in my opinion, sooner rather than later. Tomorrow we're going to have some bullish earnings that will help pave the way to the bullish side heading into the Fed meeting. Airbnb up about 4.28% in after hours. AMD up about 7% in after hours. SoFi even up 1.11%. Like I said, Lyft, that's going to be the negative one. Negative Nancy over here, down about 27%. And then you do even have Starbucks, last I checked, was up about 5% after reporting their earnings today. So coming off of a lot of good things, SoFi stock at a very attractive, valuation, a very attractive price right here. I'm still down like 55% of my shares. So, yeah, I'm right there with you guys, getting absolutely destroyed. But time is your friend when it comes to buying the dip in the stock market, especially with longer dated growth that has to prove itself over a long duration. So if I ever say long duration growth, that's what that means. Now, if the Fed is bad, watch the $5 level. That's going to be a psychological level. I know a lot of people say, like, why do you talk about the $5 level? That's a psychological level, just like on the S&P, 405 was a big psychological level, and then 400 was a big psychological level. If you don't find support at those prices, then you'll tend to gap under that, right? If the SPY does fall, and it falls under 400, you're likely to go pretty much straight to 390, or, like $5 increments. 395, 390, 385, 380, 375, 370, 365, 360, right? So key level right there, $5 per share. Then the most important level, to the upside is $10 per share. We had a triple top and then just continue to sell off. So I do expect it to be bullish. I expect SoFi stock will be bullish to end off this week, but that is all that I can give you guys. That's my take on this heading into a very important day. You also do have the JOLT jobs report, or the job opening report, that comes out tomorrow, expected to be about 11 million job openings. That could go either way. I don't think the markets are going to care all too much about that, considering it's on the same day the Fed is. So all eyes will be on the Fed, and you'll see a very violent market reaction around 2:30 when the Fed report comes out at 2, and then the Fed press conference comes on at 2:30. You're kind of going to get some clarity as to, what is going to happen after, what kind of reaction we are going to get. So that is going to be all for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Do you agree with this thesis? Do you want to add to this thesis? Am I missing something? Let me know your thoughts on this information. Thank you for watching, and I will see you in the next one.